business you're in, and then I want to know, why are you here? What brings you to the class? And if you want to show your face so we can just see all the people who are here, and then you can hide, just so I get a sense of who I'm looking at and talking to. And then just type your information in the chat, and then we can go in, and then I'll tell you a little bit more about me, and then we'll get into the meat of this. But I thank you greatly for taking your Saturday to be here with me. I'm honored to be here. I love talking about this stuff, and I love working with folks in the wine industry. I think they're the best people in the world because y'all have alcohol. Yeehaw. Okay, so dive into. Hello, QuickBooks Online and small wineries. Fantastic. I do a lot of training for Intuit as well. I speak all over the world now about different stuff, and this is great. We're glad you're here. Family Wines in Sonoma, great. Vineyard 29 in St. Helena. Testarossa Winery in Los Gatos, fantastic. Marion Adams from a winery in Fallbrook, which we said hello on screen. Wonderful. So what do you want out of this 2 hours you're investing? Working on simulation and forecasting for wine business. Okay, thank you, Mike. Becky,
where's the chat?
got here to get more familiar with the numbers. All right. Ramsgate, great site on the hill. Robert Sinsky, good to have you guys here. Hi, Rachel. Maureen from Oregon. Engineer and biomedical company, woohoo. Need to justify financial benefits of projects. Well, okay, cool. A lot of similarities between other industries and what we're gonna talk about. Farm, yeah, farms are exciting. A lot of stuff. Account for all the numbers, gain more knowledge since still a student at Dominican. Fantastic. Well, welcome everybody. Christy from Napa Wine Company, hello. Winemaker, we've met, yay. Keith from Errett Family Wineries, small family winery in Paso, fantastic, beautiful area. There's so many cool places around the country. Okay, thank you guys very much. If I missed somebody, please forgive me. I'm in finance, all right. Okay, so you guys can hide again if you want. I might even hide, so I don't have to look at myself on screen. It scares me. Don't know how I got to be that old, y'all. Okay, so there we are. I'm gonna start talking. So this is me. I have a bunch of personas and personalities and brands. BDCO CPA is a CPA firm I work with that enables me to do anything with wineries. I'm a 2-day-a-week employee of that firm, and my role there is to deliver services to wineries. So I do consulting and advisory. I don't do any traditional work anymore. I started with Deloitte as a CPA, and I did tax work, and I became a partner, and I decided I didn't want to do that anymore. And so I started doing things like speaking and trying to translate this information for audiences. So I've been speaking since 2000. I now go to places in countries like Brazil. I've been to South Africa speaking. And I talk about why accountants need to be better, why we need to make more sense of the numbers for clients and people that we work with. And then you see I wrote a book about making boring stuff interesting. I have a brand. My speaking brand is Even a Nerd. That's my business. Even a Nerd Can Be Heard, which I believe and I'm trying to make true in the world. I have a bookkeeping business I co-founded with a partner here in Napa Valley to help wineries trying to keep the bookkeeping straight. It's called Solve Services. And then I'm part of a company called Mentor Plus that teaches accountants how to be advisors. Much of the stuff that I share with you comes from my own investment in learning to be better at advisory. And so hopefully you'll have some tools that you can apply. So enough about that. So what I'm here to talk about today, and again, in 2 hours, there's a lot of stuff I could cram in your heads and make it explode, but I really want to get you the stuff that I've seen, and I've been working to make this information meaningful for more than 20 years. It's been my life's work to make what we do as accountants resonate with our audiences, because as most of you, I am sure know, very little of what we say makes a lot of sense to normal people. And so my mission is to try to change that. And so we're going to talk about financial statements because you have to have, and I'm going to go back on screen. You have to have an understanding of core financial statements and certain terminology in order to make any sense of this thing. And so I'm going to just set the bar and get us all at the same point for that. And then I'm going to talk about what financial success looks like in a winery. And then I'm going to talk about how you change financial outcomes and give you a tool that you can use to play with your own business. So one of the first words that scares people is this word accrual accounting, which is what we start with. And you can see from the expression that most people think that what that word is actually a cruel accountant, because we're scary, mean people who bore people to death and beat them to death with our superior knowledge and make people feel stupid. I think that's one of the things that we have traditionally learned how to do, is to browbeat people with our superior knowledge and say, well, you don't need to understand, but give me whatever it is that I need. So the first problem, I think, and this really became clear to me when I moved from Atlanta, and you probably already can tell I'm not from around here, y'all. I was born and I grew up in Greenville, South Carolina, but I spent 15 years in Atlanta and then moved to California with a software company. And when I started working with wineries, so I had met the CPA firm here in Napa as part of my speaking travels, and they asked me to come join them in 2007 to work with wineries here and to do consulting and advisory. And when I stepped into the wine industry, I, for the first time, I think, really understood what it feels like to not speak the language. Now, I felt that way when I was in foreign countries, but to step into an industry where you don't know what the heck somebody's talking about. And for me, that fear came from this wine industry, which is, if you grow up in the South, it's a very intimidating thing. I mean, even to order wine is a scary thing. And so I didn't know anything about it. And here I am going to teach people in an industry that I know nothing about how to do things with numbers. And so I realized that the terminology is a big separator, and that people on the other side who were trying to understand me as an accountant have the same issues. So what y'all did is talk about stuff like terroir, which means terror in Southern, bouquet, Gewürztraminer, which I still don't even know how to pronounce that correctly. You talk about the nose and the legs and malolactic fermentation or whatever that word is. I think I spelled it wrong. What is what is that? What are the lees? What's veraison? What's appellation? Those are some of the things that y'all use to separate me. And if I come into your tasting room and you talk about all that stuff, I'm probably not going to buy the wine, because I'm going to feel how ignorant and stupid I am, and I'm going to walk away, and I'm not going to value what it is you have in that fine bottle of wine. And we do the same thing to you. So I want you to type into the chat some of the accounting terminology that we use to make you feel stupid about whatever you're trying to do with finance. So type some words in there. Just give me some. And by the way, those terms were words that I heard in the first wine tasting that I did. It was presented by a winemaker who made the science the focus of his thing that he presented to all of us. And I said, I'm not drinking that stuff. Sounds like a bad chemical I don't want in my body. And so there you go. EBITDA, one of my favorite things to pronounce. Equity, yeah, equity, EBITDA. Depreciation, who the heck knows what that is if you're not an accountant? Shareholders' equity. Amortization, you heard that one? Let me give you some more terms. This is the only power we get as accountants, y'all. We're stuck in our little back offices being boring people to death, and we get to have our own language and make y'all feel, inferior sometimes. And we shut down the communication. So we have GAAP, Generally Accepted Accounting Principles. That's the book we use to dictate the rules that we apply to the accounting. Accrual, which is one that nobody understands. EBITDA, depreciation, amortization, gross profit, balance sheet, P&L. AP, that's accounts payable. Those are bills you owe to vendors and suppliers. We got a ton of them. And so those are the things that we use to make you feel like we're speaking Greek. We come in and want you to do things, and you don't even understand why or what it is we're talking about. And so that says it's Greek to me in Greek. And that's what accounting is for most people. So what accounting really is and should be to folks is the story of a business. That's where the recorded transactional flow of a business lives. And if you can't read the book, then it's meaningless. And that's what most of the information we typically provide as accountant has become. Think about a tax return. How valuable is that to you to help you figure out how to make a decision in your business? And a financial statement, it's a historical record of what happened. But in many cases, we don't help you figure out what to do about that history if it's not what you want it to be. And so that's one of the things that I've been trying to make us as a profession do more about. And the profession has adapted in the last year more than I've seen it in the more than 30 years now that I've been doing it. People are starting to realize that we must deliver more to our clients as accountants. We must help people change their outcomes, not just account for the history that is already set and determined. So the first thing we're going to talk about is financial statements. I'm going to give you some core principles and concepts, and I'm going to start at the beginning. These are things people understand, and then I'm going to connect it to financial statements, and then I'm going to show you some things about the wine industry from my experience. Again, I've been here since 2007. Some of the ratios and measures that used to be what we expect, and if we ever go back to normal, whatever that is, there's some of the things that you want to look at when evaluating your own winery success or the business you're in success. So there are two main things that we all understand that come and go when we're talking about a business. We have receipts and we have disbursements. So let's talk about receipts, because it's better to receive than to give, y'all. So the first thing I want to talk about, and this is just a basic flow chart, but I want you to understand why, if you work with an accountant, we ask you 10 million questions. If you came in and handed me a check as an accountant, as your bookkeeper, somebody who's keeping track of the transactions, I would have to figure out what to do with that money coming in. And there are a million things that that money could represent. So if you look at this flow chart, which hopefully you can see, and I also have a link. Let me get that link and paste it if you want to see it in a bigger form. It's in an online flowchart tool called Creately, and that chart is available for you to look at. I pasted it in the chat. So basically, we get a receipt. The money comes in. We make a deposit. First thing an accountant does is put it in the bank because we don't want the check to disappear. So we put it in the bank, and then we have to figure out, what is this? Is it a sale? Yes or no? If it's a sale, did it come from our retail point of sale system? If so, then it goes directly to the P&L, the profit and loss statement, the income statement. If not, then it might be a payment on account from a customer, which means it goes to the balance sheet. So there's a split decision there based on what that is related to. And then if it's not a sale, is it money coming in from a bank loan that we've taken out? If that's the case, then it goes to the balance sheet because it's an obligation that must be repaid. If it's not a bank loan or investment, then we have to ask some more questions. Is it a refund of a power deposit that we made? Is it an overpayment we made in a prior month for some expense that we incurred? What is it? And we have to spend a lot of time figuring out what it is. It might be a deposit from a customer, and if that's the case, it goes to the balance sheet. You can see this is what goes on in just a piece of paper coming in that represents a deposit into our company. And this is why accountants have to ask a bunch of questions. The worst thing that can happen is that an accountant does not make any questions happen. They just take that and make their own assumption and stick it in the wrong bucket. And then the impact that has on your financial statements can be great. So one of the things that I want you to understand is interactions with accountants are critical to making sure that information is accurately reflected in your business. So don't just think they're being picky and pains. They're trying to figure out how to do this correctly because it can really make a difference on the business as to where that deposit ends up being reflected. So I have a question for you. If I sell a bottle of wine by phone on January 1st and ship it on January 15th and receive payment on February 15th, on what date do I record the sale? So take a minute and just answer what you think in the chat. Right? Okay. So if I'm on the phone, yeah, good, all over the map, a lot of January 1st. If I'm on the phone and I say that sale is going to happen, and even if you pay at that moment, from an accounting perspective, that is not a sale until I ship the wine. So January 15th is the day. What we look at for accrual accounting, the mean accounting, the guy with the mean face, a GAAP, generally accepted accounting principles, which as a CPA, I must raise my hand and say, I swear to follow the rules of GAAP. That is what we would do as an accountant. Now, January 15th shipment date is when the goods and services exchange hands. Most people think the payment receipt is the date of sale, typically. And other people would think if I have an agreement on the phone, I have an order placed, then I have a transaction. But according to the rules of GAAP, it doesn't happen until it ships. Now, what happens in the wine industry, especially when we have e-commerce sales happening, is that we record and treat the sale as a sale the day we receive payment. If they're paying by credit card, we treat it as a sale that day. But we know if we're at the end of the month and that item hasn't shipped, we must reverse the sale in order to be in compliance with GAAP rules. So this is some of the complexity that happens at the end of the month. And particularly if you're a company that is under audit, that has an audit firm come in at the end of the year, they will come in and look at what actually shipped by December 31st and reclassify any sales that were not able to be shipped by that day. Now, fortunately for the wine industry, most wine is shipped by December. So if I were to come in June and you were accounting for sales based on when you got paid, I wouldn't worry so much about making you clean up June, because I know that by December it's gonna wash through. But that's what most of the industry is treating these sales as cash basis. When the money is paid online, I'm going to record the sale, even if it takes me a week or two to ship it. So that's a kind of a confusing thing. The rules say it must be shipped to be considered a sale, but our systems are not set up to let us report very efficiently that way. And so we have an industry, at least in Napa Valley, have sort of agreed that we're going to treat our point of sale sales as sales on the date that we have the money in hand. Now, this doesn't mean we don't have to eventually maybe return some of those sales, but that's how we agreed as an industry to do it. So that's called an industry convention. That and that's why it's called generally accepted accounting principles, because industries can come up with their own best practices. But again, if I'm an auditor, if I'm a financial statement auditor and I come in at the end of the year and you haven't shipped some stuff that you've been paid for, I will back it out and call it a deferred or unearned revenue item for your winery. So that's why I want to explain this whole accrual concept and some of the principles that guide what we accountants do, and why we drive you crazy when we come in and take away your sales. So if it's a cash sale, it's pretty simple. And this is Swanson's winery brand. They had some cool, funny names, so I picked their wine bottle. But basically, step one is exchange the items. So we take the bottle of wine and we exchange it for payment. That's if we're doing a cash sale. And then step two is we have to account for the cost of the wine bottle that we pulled off our shelves. So there's two steps in a cash sale. Most people get it. There's the wine, I get cash, I got a sale, not any big issue to worry about, pretty simple. The timing of a cash sale is the sales recorded at the time of the payment, and that's retail stores, and tends to be online sales for us, even if the goods or services are not exchanged. But we buy goods on account, and most businesses operate that way. We're not pulling things out of the cash register in a winery and paying for our power bill or buying paper from Staples or doing that thing. We're receiving the goods or services first and then paying at some later point in time. So what we determine as a sale is the promise and agreement. It's the exchange of the goods or services in exchange for a promise to pay. And then we have a separate transaction when we get paid for that exchange. And so there are separate transactions that we have to account for. So step one is to exchange the good or services for a promise to pay. So here I have my wine, and now what I get back is basically an IOU. If I'm shipping wine to a distributor or to a restaurant, that's what's happening. We're sending the bottle of wine out and we're receiving an IOU from them. Step two is we record the depletion of the inventory because the wine is gone, and that's called cost of goods. That's the cost of that bottle of wine that we pulled off our shelf, cost of goods sold. Or if we're doing services, we record the service costs that are exchanged. And then step three is hopefully, fingers crossed, 30 to 90 days later, we're going to collect the cash on that exchange that happened. And in times of difficulty, like we've seen during COVID and like we saw in 08 when we had a recession, the 30 to 90 days drew out to 120 to more days, and we're hopefully able to still collect from some of those accounts where we had sales. But that's how that works. So those are sales on account versus cash sales. So that the settlement happens when the IOU is cashed out for dollar bills or cash or checks or whatever it is. So the accrual method of accounting is the method of accounting that most industries use. It's what we as CPAs are required to apply. If we don't apply that method of accounting in preparing your financial statements, we must put a letter on front of it that says these financial statements have not been completed in conformity with GAAP, generally accepted accounting principles. And you can use the tax method of accounting, you can use cash basis, you can use other things, but we must say that you are not in conformity with generally accepted principles. So the accrual method of accounting tracks the promise and agreement, is more accurate because it reflects what really happened. It's the underlying exchange that is what is the transaction that reflects an accounting impact. And we don't want to wait until the payments are actually received. And most businesses use that method. Wimpy from the Popeye Show is the patron saint of accrual accounting. Wimpy, if you recall, would always say, I will gladly pay you on Tuesday for a hamburger today. So think about that. That's the concept. That's the underlying approach of accrual accounting. So now I want to talk about disbursements. Everybody okay? Breathe. I'll take a minute. So we talked about receipts, we talked about cash basis, we talked about accrual accounting. Now let's talk about disbursements. That's money going out. Those are things that we are acquiring for the business. In most cases, we're going to think about purchasing on the accrual basis. Again, we buy on account. We get the goods or services, and then we have an obligation to pay someone, a vendor or supplier, at some later point. So here's a question for you. Answer in the chat what you think. I spend $10,000 on marketing brochures. Where should I expect to see those charges? Is that an expense of the business that will show up on the income statement? Is that inventory on the balance sheet? Or do I not have enough information to decide? So put your answer in the chat. What do you think? Expense, Larry says. Expense, income statement, expense. Marketing, right? It's usually an expense. So again, here's why accountants are pains, y'all. We don't have enough information. There we go. Stan said, need info, immediate use or over time. So if you're the marketing manager and you're measured on profitability in your department, you want the accountants to ask you a question, which is, what does that $10,000 investment represent? Are these brochures that are going to last 4 or 5 years? Are we buying one of those slick brochures that has the winery image on the front and tells the foundation story and the backstory and can be used year after year? Or is this $10,000 for a limited time promo that's going to be used up in the next month? If this is a brochure that's going to have a longer life, then I'm going to put it in inventory on the balance sheet and I'm going to deplete it as I use those supplies over time. If it is something that's going to be totally consumed and wiped out in the next month, then it's going to go to the income statement as an expense. But again, this is what the accountant needs to figure out. And if they see that 10,000 and just automatically stick it into the expense account, then the manager of that P&L is going to be hit for a big whopping 10 grand in the month in which that was incurred, versus having it spread over 3 or 4 years. So you want to know what's happening with decisions that are being made like this. And if you're the person spending the 10 grand, you want to make sure that you know this is a 10-year supply of this particular kind of collateral. So here's the similar kind of flow for a disbursement decision that gets made. Somebody makes a purchase, we go, well, the goods or services, we have to know, will whatever you bought continue to add value to the business over time? And if the answer is no, then we have to find out, does it represent items that are going to be sold in the course of our business? And then we have to answer that question, because that dictates whether it goes to the income statement or the P&L, profit and loss statement, or the balance sheet. And then if these are goods or services that do add value over time, which is generally longer than a year, we have to know, does it represent an invoice for advanced services that are going to be delivered at some future point? And yes, then it might be something that goes to the balance sheet as a prepaid. If no, have you bought a big asset like a truck or a harvester or a tank or something that's going to be used year after year? If so, it might be a fixed asset, and then I have to depreciate that asset. Depreciation is a convention accountants use to estimate the declining value of an asset over time. So if I buy a tank and it's going to last, I think, 5 years, then I'm going to take a year's worth of that cost and write it off over those 5 years. And by writing it off, I mean record it as an expense on my income statement or P&L. So fixed assets are treated differently. A prepaid investment of something or a deposit has a different impact on the financial statements. A purchase of something to be resold generally gets recorded in inventory. And something that's going to be consumed and gone after either a short period of time, generally less than a year, generally in that month, will go directly to expense and will show up on the income statement. So again, there's a bunch of decisions that determine where that disbursement transaction is going to show up on the financial statements. Again, I have another link to that. Let me get you that link pasted if you want to go look at that graphic in much more readable format. Go for that. Okay. Any questions? Anybody have a question? I'll Take a moment and look at the screen if you want to come on or unmute yourself. Question or a comment? I don't see any unmutes happening. Okay. All right. Let me know or chat if you need me to answer something. Okay, this brings us to the next concept of accounting that drives people crazy. And this is this concept of matching. Again, part of what we sign up to do as CPAs is to make sure that revenues are associated with the cost of generating them in a given period. It's an alignment between what we've expended and what we're able to generate in revenues. That's why it's an accurate way of looking at what we've actually done in the business. And that's a premise of this GAAP, generally accepted accounting principles concept. And so we're always going to be looking at what you spent or dispersed and where it belongs in terms of the period in which that cost should really be recorded. So there's a lot of stuff that we do that people don't understand. And that's one of the big concepts that dictates that. So accounts payable and accounts receivable are accrual-based accounts that exist to keep track of what we owe and who owes us. So accounts payable are the amounts that are due at the time we exchange a good or service, and they're typically associated with expenses. Accounts receivable are tracking sales that we make on account. Paste the link above, Dan. Which link? The link should, you want me to paste it in again? Okay, you should be able to scroll up and get them even if we've moved on. Dan, is that what you need? The last link, or do you want the first one? Dan, can you come on or unmute?
Yeah, hey, I got the first one to work. Just the second one goes to a blank page for some reason.
It doesn't work?
Maybe it works for somebody else, but I'll try to.
Should I'm in it. Oh, whoop. Well, that's nice. There, it just takes it a minute. I think it just might be a timing thing. Try it again. Just wait. It took it a minute for it to come up. Anybody else able to get it? I'm at that link and there, maybe it requires a login. If that doesn't work, I'll send it out after the session. Nobody else is able to get it either. Okay. Well, so much for that idea. It's a public document. It should be on that site at that location. Okay, I'll send it back out to you. I'll either print it big or send you the link again. I apologize for that. Let's go back to where we are.
Geni, did you get the other question? I didn't see if you answered that one.
No.
Above the link problem.
No.
About P&L and income statement.
Okay, no. Let me go back here. No, can you just read it to me? I don't see it.
I'm going up. Oh, let's see. It was from Stan. He's asking about income statement and P&L, interchangeable terms, and he thought that GAAP had moved away from P&L.
GAAP hasn't moved away from P&L. What I'm teaching you is what you will hear people say, and GAAP is one thing. So when I issue an audited financial statement, I will use the terminology that is dictated for that purpose. But when we're talking about financial statements internally, people still say P&L, profit and loss. They say income statement. The actual term is, I believe, statement of earnings now, and they keep changing the mandated audited financial statement header, but that doesn't mean we talk about it that way. So that's one of the things that I want you to know as part of this session is ask the person talking about the thing you don't understand what they're talking about. Don't be afraid to say, are you saying P&L? What does that mean? Profit and loss? Is that the same thing as an income statement? And many companies have their own terminology for that financial statement. So it might be the statement of earnings. It might be some other acronym. And people at places like Constellation and big companies, they have some standard document that gets passed out, which is basically the abbreviated P&L for the internal folks. So find out what they're talking about and what that means to them. And don't be afraid to ask those accountants questions. Accountants love it when you make them feel important by asking them a question. So make sure that you don't just assume you know what they're talking about and then go off in the wrong direction. And that's one of the things that I think a lot of us do. I was a director in a software company. We had a group of us reporting to the president, the CFO would come in and pass out the financial statements and say, here's the results that we have for the month. We need you to go fix accrued vacation. We need for people to start taking their vacation so we can approve accrued vacation. And he said, do you guys know what we're talking about? And he said, everybody said, yeah, oh yeah, we'll take care of it. And they left the room. We all went out in the hallway and everybody went, what the heck does that mean? And what am I supposed to do? And I knew, I mean, I was a CPA, but that's what happens. People aren't allowed to raise their hand and go, what's the balance sheet? And so we just all go around and everybody assumes everybody else knows something and nobody does. And so we do a bunch of stuff that makes no sense from a financial perspective. So, you know, I'm here to stop that. I want to change that. Don't be afraid to ask. You're not supposed to be born with this nerdy knowledge unless you grew up like I did and decided in 7th grade you want to be a CPA. But that's a sad story you don't want to hear. Okay, so accounts receivable track sales that we make to customers on account, and that's an association between sales and accounts receivable. Yeah. I'm having a hard time looking at the chat. Okay, the link worked for me. Removed app from the URL. Okay, thank you. That's really strange. All right, thank you very much, Mike. Good job. Mike's our technology expert from this point forward. If you need to ask me a question, please take yourself off mute because I can't manage the slides and the chat and the video and all that stuff because I am unable to walk and chew gum at the same time. So just come in and say something to me, or Jennifer, maybe you can monitor the chat and let me know if there's something I need to address.
Yeah, absolutely.
Okay. So financial statements. So let's talk about what financial statements are. These are built from transactions. Transactions come together to create the basis of financial statements. So the financial statements can either be based on the agreement, and that's where we have this exchange of goods or services, or they can be based on settlement. That's the cash basis of accounting that many small businesses use as the basis for their financial statements. And the difference between the two is the timing of the transactions that we're monitoring or tracking. So if you think about what we do in the transaction space, we have a sale that happens at some point in time, and then we have a collection that happens at some other point in time. This is sales on account. And maybe the time is the same time. So point of sales, we could have sales and collection on the same day. But in typical businesses, we have sales happening at one point and a collection happening at a later point. Then we have another sale and we have another collection happening. We incur expenses and then we pay for those expenses at some future date. And we do that multiple times in the course of the business. So when it's time for us to generate a financial statement, what we do is draw lines over our defined calendar year or fiscal period, and then we measure what's happening at that point in time. So let's say we take January 1st to December 31st, we draw the measurement gates down and we say, okay, what's happened during this period? Well, we sold some stuff, we incurred some expenses, but we also had collections of things that we sold in prior months, and we paid bills for things we bought in prior months. So what happens is we then create an accounts receivable balance for those uncollected sales that have been collected in the current period. And then we record accounts payable for the expenses that we still owe as of that December 31st date. So then when we measure, we can see the remaining balance based on what we're able to collect during the period that we track. We can also see the expenses and revenues for the period that we're tracking. And that means we can create an income statement or P&L or a statement of earnings, and we can create a balance sheet at that point. And that's what financial statements are doing for us. They're looking at what we started with in terms of who we owed and who owed us. And then the income statement is reflecting the current period activity, what we sold less what it cost us for the things that we sold. The statement of cash flows is telling us what changed hands over that period, impacting cash. And then we end up with our ending balance sheet that shows what is left for the obligations that are coming in and the obligations that are going out. And so what we're looking at is different points in time. So let's say we have an accounts receivable balance. At the beginning of the year, we were owed $1,000 from people who had bought stuff and not yet paid. So we add in whatever sales we make for the current period on account, and then we reduce that by whatever cash we're able to collect during that period that we're measuring. And what we end up with at the end of that year is an outstanding accounts receivable balance of $2,000. Same thing is true on the accounts payable side. Let's say we owe vendors and suppliers $500. We incur additional expenses. We buy stuff on account for $5,000. We pay a portion of those bills, $4,600 during the course of that period, and we end up with an accounts payable balance of $900. That's how accrual accounting works from the transactions to the financial statements. It's basically just a timing decision that we make. Now, if we were doing cash basis, we would record only the impact of the stuff that we paid cash for in a given period. You can see how that can distort the measurement results for the business. If I were looking at just cash basis and only recorded things when I got paid, I could have a bunch of sales I made in January that I didn't get paid for until April, and I would not record those revenues until April. And yet I could have incurred expenses in January that I actually paid for in January. So I'd have a bunch of expenses hitting in January and not show that I had revenue until April. And that's what we are trying to avoid as accountants. Even though those expenses that I incurred in January were related to the April income I was able to generate, I wasn't able to align the revenue with the related cost if I'm on a cash basis. So take a second here to pause. Anything I need to address? Everybody got it? Okay, so that's a core disconnect in most people's minds. Most people get the concept of cash basis. Again, why many small businesses are always on a cash basis of accounting, because it's all they can understand. But it does not allow you to plan ahead for what you owe for things that you have already gotten in your business. It is a very short-sighted way to run a business. It's almost like running your business from a checkbook, and it makes people create messes in their business. So let's move up a little bit higher level from the transactional stuff to really thinking about financial statements. A business has basically three main goals. The first one, and the winery in specific, is its goal is to sell wine for more than it costs to produce it. And that is reflected to us on the income statement. The second goal that we should have in our business is to get a return on our investment. And think about that. If you have a winery, you have invested a heck of a lot of cash to buy the capital, to build up the brand. If you have a vineyard, to groom and manage the vineyard, to buy the land, to create the building, to set up a tasting room, you have all the stuff that's invested. And the balance sheet shows you in a longer term view whether you've been able to increase the value of that investment that you made in the business. And so that's reflected on the balance sheet. And then the final goal that we should have, and that many people forget about, is that they need to have enough cash in that business to keep it alive. That has become a very big priority right now based on what's going on in our worlds. And because some of the sources of cash that we used to rely on, for those of us, those wineries that had tasting rooms, that was shut down overnight. And so we've needed to make sure that our e-commerce activities have allowed us to maintain that flow of cash to keep the business running and to enable us to pay the people that work in that business. And so the cash flow statement of cash flows, is the third financial statement. And I'm not sure why I left out statement, I called it the cash statement, but it's the statement of cash flows is a term for that. So again, income statement, audited will be called statement of earnings, the balance sheet, the statement of cash flows are the three financial statements. But those are basically the three things that we must monitor to be successful in business. Most people, unfortunately, only monitor the one, the income statement. They look for profit or loss, and they assume that that is going to equal money that goes into the bank. And unfortunately for them, it never does. And so this is what hopefully you're going to walk away with an understanding of. So I have a tool that I created. This is also available online. Hopefully my link is better. I want you to go to slideshare.net, which is a public slide sharing site, and just type in my name. And you should see it's called Understanding Financial Statements. I created this deck, this concept, because people didn't understand financial statements, and I needed to find a graphical sort of silly way to get them to make sense of it. So if you think of your business as a tree, you know, we have a tree, we're going to do an apple tree, we grow stuff, we are measuring the yield of the tree on the income statement. It measures the fruits of your business efforts, and we have apples. So if we were going to look at that tree and measure how many apples we were able to generate, that would be reflected on the income statement. That's the yield of the business efforts. And like a tree, you know, the tree doesn't have fruit on it all year round. Your business produces an annual yield, and at the end of the year, it goes to zero. That's what the income statement does. There's nothing on the tree at the end of the year. That doesn't mean the tree's gone. It means you just come back and start anew at the beginning of the next year. And that's what the income statement does. It measures the transactional activity during the course of the year. It shows you how much profit you generated based on the revenue and expenses that you incurred for that period. So it's to think of the trunk of the top of the tree where the fruit bearing part is. That's what the income statement is focused on. What is the yield that I'm generating at that tree? It starts at 0 at the beginning of every year and measures your ability to generate an annual yield. And this is what an income statement looks like. The basic components of a income statement, a P&L or a statement of earnings, is going to be that profit equals revenue minus expenses. Revenue generally reflects what we call above the line components, which is revenue less direct costs of the wine that we sell. Sometimes you'll see events, sometimes you'll see discounts, you'll see various and sundry things. Sometimes shipping revenue will be included up there and above the line. Sometimes it will be gross shipping revenue. Sometimes it will be net of shipping expenses. And so there are different ways that different wineries reflect the same sorts of transactions. The P&L or income statement is not legislated to a great detail level by the GAAP rules. So there's a lot of play in how you can present your income statement in a winery and across different businesses. They tend to be, the audited income statement financials tend to be very summarized. And so what you do to manage the business and how you report internally is an area where you have some flexibility. So we refer to the revenue less cost ending up in gross profit as above the line. So if you hear a business owner say, what do we need to do above the line to generate more gross profit? That's what they're talking about. And again, gross profit is the first thing you have to achieve to be a successful business of any kind, and especially to be a successful winery. In most cases, we're able to generate a good amount of profit, provided that we have cost controls in place and that we have awareness of what it costs for the wine that we are selling. Generally, operating expenses are the next thing we worry about on the P&L or income statement, and that's where department folks tend to be given responsibility and focus. So we have sales and marketing, we have salaries and wages, rent, and utilities. Those are all grouped together, generally calling them operating expenses, which are subtracted then from the gross profit. We end up after that is operating income or loss, which is generally the managerial earnings of the business. And then we take out other things that people can't necessarily manage: interest expense, other income, and unusual sorts of things that are happening in the business. This is where depreciation and amortization come out. This is where income taxes come out below the operating income level. So the first thing I want you to know about the income statement is that the first bottom line, the one that most people look to, is net income or loss. But what's important, and this is a term that came up on your list of terms you didn't understand, EBITDA, that stands for earnings before interest, taxes, depreciation, and amortization. This is called manageable earnings. This is managerial earnings. This is what somebody who's running a department should be held accountable to, because all of this stuff below that are decisions they do not have a hand in. They aren't deciding how long to depreciate an asset that is purchased. They're not deciding about the interest rate on bank loans. They don't have input on those sort of higher level activities. And therefore we want to measure them on this operating income or EBITDA figure that is part of the income statement. The biggest question this financial statement answers is, did I make a profit? This is question number one for any small business owners. And according to what I see here, the bottom line for this business is $11,000 positive. And the answer would in fact be, yes, you did. Is that all you need to know? No, we got to go look further in that business. So right now we've measured the activity in that top part of the tree where the yield, where the fruit is being born. But at the end of the year, that fruit is actually moved to the trunk of the tree. Those net earnings are added to what we call retained earnings on the balance sheet. So that fruit gets stored in the trunk of the tree. And that is the portion of the tree that is the equivalent of the balance sheet. The balance sheet is a picture in time, and it measures the cumulative result of all of those business decisions that you've made. You have to have a strong trunk of the tree to sustain that business over the long term of the business. So if you have a huge investment in growing more fruit at the top and don't shore up the trunk, that tree will fall over. So the trunk is required to be sustained. It's where you count up the impact of everything that you've done over time and figure out if you've actually grown the value of that business. It measures what you own and what you owe. What you own is called your assets, and what you owe is called your liabilities. The difference between the two is reflected in the equity section. So assets minus liabilities equals equity. And that is the gross value of that business. That is an approximation of what you could liquidate the business for as of that point in time. That tells you if you have in fact grown the business or reduced it over time based on the activities that you had. So again, equity includes net earnings every year. It gets rolled over into equity and it's called retained earnings as a line item on that balance sheet, but it reflects the accumulated earnings or loss of that business. And if you think about the trunk of a tree, if you were to slice it open, you could see the accumulated rings on that tree that reflect the good years and the bad years. You can count those rings and see how many years you've been in business. And you can see how many years were difficult ones versus those that were strong years, where you were able to add a lot more width to the trunk of that tree. So any of those rings represents an individual year that is coming from the income statement. So again, if you think about slicing open that trunk of the tree, what you would see is the story of the accumulated earnings for that business. Equity equals retained earnings. It also includes some of the beginning investments that owners have made into the business, but it is impacted and grown by historical earnings. It's one of the only way that you can grow equity in a business is by generating positive earnings year after year. Those positive earnings can also be depleted in the form of dividend distributions to owners of the business. So the income was strong, but decisions were made to deplete some of those earnings over the course of the year. It'd be like peeling out a section of that trunk, leaving the tree in place, but maybe weakening it by removing some of the bark, if you were thinking about my tree analogy. So here's the winery again. We have assets and liabilities. The assets are what you own. The liabilities or debts are what you owe. And again, the difference between the two is the equity that is reflected on the balance sheet. You see the stockholders' equity. That's going to be a reflection of the accumulated earnings. You'll see the equity termed differently depending on the ownership type for the business. In this case, I have a stockholder, so that means I am an incorporated entity of some sort. You'll see members' equity if you're talking about an LLC. You'll see owner's equity if you're talking about a sole proprietor or unincorporated business owned by an individual. The balance sheet is actually legislated by our rules of accounting that tell us how to order the information that we display on that financial statement. The items are arranged in order of liquidity by dictate, and that means the things that are most quickly converted to cash have to be first, and then everything declines based on that. So for our balance sheet that we see here, cash is always going to be at the top. Accounts receivable are more easily converted to cash than is inventory because something has already been sold. We just have to collect. For wine inventory, you have to sell and then collect. So it is less liquid than either cash or accounts receivable. The same is true for the liability section. Accounts payable are due faster than other things like line of credit and long-term debt. So you'll see them at the top of the financial statement of the liabilities and equity section. And those all represent amounts that are owed by that particular business. So again, we want to look at what we own and what we owe. And hopefully we have a lot more that we own than we owe. And that's going to reflect in the accumulated earnings of that business, also known sometimes as net worth and also as equity. So this financial statement answers the question, what is my business worth? It is the approximate value at liquidation. If I were to liquidate this entity right now, I would expect to receive in 2014 $435,500 for everything that I have reflected on the balance sheet. Now, the problem with that is our financial statements are created based on cost. So if you think about a winery that has a bunch of land or a bunch of assets, the balance sheet would show those assets at what they were purchased for. So in Napa Valley, if you bought land in 1970, you might have spent $3,000 an acre. If you tried to buy that same land today, you would probably be lucky to get it for $300,000 an acre. And so the financial statements don't reflect the fact that it is worth $300,000 today. They reflect what you paid for it back in 1970. And so that is the one fallacy. It's one of the things that there's been a lot of discussion about in accounting, that we should go to a fair value presentation, but we keep defeating that concept, and we're taking the conservative approach and showing you worst case scenario, you should be able to get what you paid for it back and then use that to pay off your obligations. And here's what you would anticipate at least receiving back were you to liquidate that business. So that's what a balance sheet does. And again, the accumulated earnings answer that question. What is my business worth? At a conservative approximation, here's what you can expect to receive at liquidation. So we have that trunk of the tree. Again, that's what we're measuring when we think about the balance sheet, and a tree cannot bear fruit unless there's the support of a trunk. So if you're focused only on that P&L again, and you don't maintain those assets that are underlying it, like the tasting room facility or crush facility, or all those assets and all those things that have to happen for you to be able to produce the wine and sell the wine and do all those things, eventually the entity is going to collapse because the weight of the yield is going to force that trunk to crack. And so you have to make sure that you're maintaining not just the P&L focus, but also a balance sheet focus, and also a third thing that we're going to bring up in a minute. And so you can't produce that annual net earnings if you don't have a solid foundation in the form of a balance sheet to support it. You've got to have the assets. You've got to have the investment in the facility or the software or whatever it is to keep that business running. Otherwise, it won't last over the long term. The third aspect is water. If you can't have water in your tree, it's not going to survive, right? We can't just stick a trunk in a apple-bearing tree on a desert and expect it to work. Just like that, a business can't survive without cash. So if you think about the water in that system, in that tree system that we're talking about, we need a way to measure that. And that's what the cash flow statement does. It measures the amount of water running through that tree. It's the lifeblood of the business. Cash is critical for success. The financial statement, the statement of cash flows, actually connects what's happening in the income statement to the balance sheet. And operating cash flow is the bottom line from that statement that a bank will look to determine if you can repay a debt or obligation. The cash flow statement tells you where the water went in your business. It answers the question, how much cash was consumed by the income statement in generating the profit and expenses? How much cash was consumed in growing that balance sheet? How much did I invest in inventory and customer receivables? And then that's going to give me one indicator of where all that water ended up going through that tree. And this is what it looks like. The statement of cash flow, we start with net income, and there are multiple ways to report on cash flow. This is the one that to me makes it easier for people to understand. There are movements in accounting that have actually changed the way where they actually show each item in and out, but this one takes income, adds or subtracts the depletions of those earnings that were invested in the balance sheet, shows what came in from outside investment decisions that you made, shows what happened in debt repayments and credit line extensions, and then ends up reconciling the cash that you started with at the beginning of the year to the cash that you ended up with at the end of the year. And it is that operating cash flow that is critical to keeping the business going. If you do not generate positive operating cash flow, you will not be able to sustain that business for the long term. Your tree will die and fall over. So we start with net income. We add back depreciation, which is again a non-cash item. It's an estimated cost of wear and tear. And so if we're looking at cash, we shouldn't take that out of our net income. So we add it back. We reduce our earnings that should have gone to the bank by the amount of money that got tied up in waiting for our customers to pay us. So net income reflects the sales that we made, but it doesn't mean we got all the cash. And so if our receivables went up, that means we are loaning our customers money, and that means that we would have less cash than we otherwise would. If we invested some of those earnings, some of the cash that came in the form of an inventory increase, that would also reduce the cash available on hand. If we increase the debts to our vendors and suppliers, that is actually money we have kept in our bank. And so that adds to the cash that we have in the business. And again, you add those up, and that's what the operating cash flow is for the business. We then look at what we bought. If we invested in assets, or if we reduced our current assets, we would have an impact on cash. You see property and equipment. We spent $17,000 of the cash that we had to buy new assets, and we did something else that grew our current assets and used up cash. We then went out to our outside financing options, and we ended up paying down our long-term debt by 18,000, but then we had to go borrow from a short-term debt source of credit, line of credit, and that gave us another 15,000 back. So we add up all the cash coming and going between these three different places in our business. We look at our beginning cash balance and we add or subtract based on what happened to cash overall, and that gives us the ending balance on the balance sheet in our cash account. So this is how you bring all the pieces of the financial statements together and you get the full picture here. You cannot make good business decisions unless you understand the cash flow statement, the statement of cash flows. And from my experience, very few people understand it. Even fewer people even run this thing as part of their standard financial statement package. And it is, to me, a huge gap, especially in an industry like wine, where cash flow is so important. And Roberta has a comment that if people don't use the cash basis and don't have AR and AP, yeah, you can look at balance sheet changes to still get a sense of what's happening with cash flow. You could also just run the cash flow statement and get that same information generated. So if you ran a beginning and ending balance sheet and you subtracted the two balances, that would give you the impact on the cash flow statement. That's how we do it as accountants. So the cash flow statement, most important, again, I mean, very important, not most important. They're all equally important, but it answers the question, if I made a profit, where's my cash? Which is the number one question that I've gotten over the course of my long and boring career in accounting. Nobody ever understood that, especially an owner, when I would come in and make a bunch of adjustments. And then I would have to say, well, you know, you bought that $50,000 asset that's this year, you had profit, but you invested in growing your inventory. You grew your asset base, you bought more fixed assets, you paid your vendors faster than you were paid by your customers, which depletes cash. And here's the story. Look at your cash flow statement and I'll walk you through each of these items. And this is what it's telling me. Yes, you generated profit, but you invested that profit back in different aspects of the business, whether you intended to or not. So the moral of the story here is it's a very delicate balancing act. We have to measure all three aspects of this tree system that I'm using. The income statement is measuring the yield at the top. The balance sheet is measuring the sustainability, the sustenance, the core structure that allows you to grow that yield. And the cash flow statement is measuring the use of the water across that system. Where did the money go? Where did the cash go? It answers that question. If I made a profit, where's my cash? So that's the analogy there for the tree. And again, on the slide share thing, you can just walk through that. It has like little pop-ups that give you more, but it's designed to be a self-running thing. There's no audio. You just walk through the slides. And if you have anybody that you want to educate about this and who may not want to say they don't understand it, I think I've had 100,000 downloads of that thing so far. It's people who are out there looking for an explanation. And it tells you that there's a lot of people who don't know what this is. And again, we're not allowed to ask. At some point in our career, we're supposed to automatically understand all of this stuff. And I don't think it happens unless you spend the time to get trained or somebody sits down and explains it to you. You guys are ahead of the curve. Okay, so now you have a core understanding, hopefully, of financial statements, how they work together, some of the terminology, and that you've learned not to be afraid to ask. It's 11 o'clock. I'm going to take about a 4-minute break so you can get up and replenish your caffeine and I can get some more water. I'm going to open up and look at you. Anybody want to wave at me so I know you're still awake and still there? Hi, Jennifer. Hi, Alicia. Jen, Roberta, yay, look at all these faces. Y'all still awake. So grab whatever you need and come right back. So let's say 5 minutes. I'll start at 11:05.
11:05.
Yeah.
Okay.
11:05. Thank you. Thank you. Thank you. Good to see you guys. We understand what we have to measure in general for a financial statement. We have to understand what's happening in the P&L, what's happening at the balance sheet, and what's happening in cash flow. So let's talk about what we know about the wine industry. And these are the winery business models, traditional winery business models that we run into. We have people who do their own farming, they have their own vineyards, they do production, and then they sell stuff. So that's complicated enough if you're doing all of that. You've got farming business, you've got a manufacturing process, you've got multi-channel sales, you've got all sorts of things to manage across that business. Some wineries have just a production facility, and then they have sales, and maybe they have custom crush as well as a revenue stream. And then other folks just sell stuff. They buy and resell, and they outsource the production. They do something else. So if you're going to go and start in this business with the least amount of capital invested, then you want to go the sales route. If you're going to invest the most amount of capital, you want to be in the farming side. And by capital, I mean, you're going to buy a bunch of assets. You have to buy the land, you have to buy the buildings, you have to do all of those stuff. So that's the most capital intensive. Fixed asset is also referred to as a capital asset. And again, a fixed asset is an asset that you buy that adds value to the business beyond a year. And typically and individual companies decide what their limit is for capitalizing an asset investment that they make. And when I say capitalize, it means put it on the balance sheet instead of writing it off as an expense. So if I bought a $1,500 computer, most of you would think that might be an asset that adds value beyond a year. But if I'm in a company who has a $2,500 capital expenditure convention, they will write that $1,500 off as a current period expense because it's not worth tracking it for 5 years. It's $1,500. Their limit is $2,500. So anything that you spend over $2,500 will be reflected on the balance sheet as an asset investment called a fixed asset. So companies have different limits. So one of the things you need to know about your own business is, what is our capitalization policy? At what point do we put that computer on the balance sheet instead of on the income statement or the P&L? So that's one of the aspects of this. Wineries tend to have a lot of asset investments called capital expenditures or CapEx. They go on a different budget than the P&L, and they tend to be quite pricey, especially if you're doing this full stream winery business. This tends to be estate wineries. And then you have production, sales, different options. So how do these different business models compare? If you have a vineyard and you're doing production and sales, you tend to see, and this tends to be from my experience in Napa, estate wineries that have the highest margins. Now this may vary in different regions, but you tend to see people who have control over the fruit tend to have higher margins on what they're able to sell. And that's a margin that's higher. Margin is another way to talk about gross profit. Typically it's a percentage that you measure, but it can also be referring to that gross profit line on the P&L that I showed to you previously. If you look at the balance sheet for this type of a winery, you will see a heavy asset investment, generally land and equipment. The cash flow for this form of business is the slowest. It takes the longest time for these businesses to get to positive cash flow because they invest so heavily in assets. And you tend to see negative cash flow. It's why you see people with deep pockets generally coming into this industry, because it is a very slow boil to get positive cash flow. If you're just doing the production and sales, you can have a high margin as well. You can have a medium asset investment based on what you're trying to do, and more steady. Stan, is that a raised hand or your arm hurts? Sorry, that looks like a recent wound. Is that a recent wound, Stan? Sorry. Yeah, keep it up. It won't hurt as much. I'm sorry. If you're just doing sales, you tend to have lower margins because you don't have control over the cost elements. And then you have less of an asset investment, generally just in bottled inventory that you're buying. And you can get positive cash flow early. We see a lot of people coming in that way. We see winemakers who want to have their own wine business, buy somebody else's fruit to start, and then hopefully grow the investment so that they can buy the vineyard and set up a tasting room or whatever in the future. So those are the options. How do you change the results across any of these businesses? What if net income is too low, or cash is tight, or you're not generating sufficient return on the asset? So we're looking at all the financial statements and we see that something is off. What is it we can do as a winery to change the outcome for that business? And I'm gonna, let's see here, just a second. Go. Well, one of the things you can do in any of these types of businesses is consider the channel mix. So most of our wineries, again, Napa Valley, we have multiple channels of folks that we are selling to. And this is how we refer to it. So we have direct to consumer, which is typically the point of sale and tasting room sales. And then people refer to on-premise sales, which is selling directly to a restaurant. And then we have FOB, which is or distributor or wholesale, however you refer to that, which is selling through a broker or a distributor. We tend to see the margins drop as we move down this list. The FOB is the lowest margins, but people do that to generate higher volume and also to generate brand awareness. Typically, if you can get a distributor to pick up your wine, then that's going to help get the brand out in more locations. On-premise tends to have the medium margin. Again, you're selling directly to restaurants. We have something called, what they call it here is California wholesale, and that is lower margin than direct to consumer, but higher than the distributor, wholesale, or FOB, whatever you want to call it in your space. And again, some of this terminology is specific to a winery. How you refer to the channels might have your own internal technology. So again, ask what they count as what, and make sure that you understand that. So direct to consumer obviously has the highest margin of being charged whatever they want, and they pay us, we get the money fast, hopefully. And we make more money on it. And you don't have to have receivables if this is the only way that you're selling.
Geni, are you supposed to be sharing a screen by chance?
Am I not sharing it?
No. I can see you're like clicking, so I think there's the presentation.
I'm sharing it with myself, apparently. Okay, let's go back here. So you saw, so the different options. So there's a graphic here. Jennifer, do you want to share the slide deck PDF?
Yes.
On the chat? Go ahead and make that available to people. So here's the graphic for how these different models compare. I apologize for that. Thank you for hollering at me. And then to change the results, if net income is low or cash is tight or not generating sufficient return, you've got to first go to the channel mix. So this is the revenue streams that you have, direct to consumer, on premise, and FOB or wholesale. The income statement, what you will see across these different options is that direct to consumer is going to generate the highest margin, on premise is medium, and then the lowest will come from distributor activity. If you look at the balance sheet impact of being all direct to consumer, then you wouldn't have receivables. If you're on premise, you're going to have accounts receivable. And if you're selling to distributors, you're also going to have accounts receivable. The receivables from distributors generally take the longest to collect, which means you're going to have the biggest impact on your cash flow. If you're looking at the cash flow statement in the direct to consumer channel, then your sales are tied to the cash. If you're selling point of sale or tasting room, then all the sales are going to immediately turn into cash, which is a nice thing to have. A particular amazing model to me when I first showed up in the wine industry was this whole concept of wine club. I looked at people when they first told me about it, and I thought they were trying to pull one over on me because I was just a dummy from Georgia. I couldn't believe that was a model where you come into a winery, you sign up for wine in the future, you give them your credit card, and they charge you whatever they feel like for whatever they want to ship you. And then you say, Yahoo, I got wine. And people do it. And they charge your credit card and you get a shipment of wine. And then of course I went, well, sign me up. Sounds cool. But talk about a cash flow brilliant thing to do. Whenever you need to have a crush investment or harvest, you generate a wine club sale and you fund the cash flow that you need to pay for that harvest activity or for the crush activities or whatever's going on. And that's what people have learned to do. It's a brilliant model. Something I don't think I've seen in any other industry, but maybe there's one and I just don't know about it. But a cool thing, and driven by cash flow, people figured out that they needed to have these cash flow options at peak expenditure times in their business. Okay, so Jennifer just put the slide deck. It's got 3 slides to a page, so you can make more notes. I didn't want to give you all of it up front because I wanted you to answer questions without having the answers in front of you. So take that. You have all the slides, and I'm sorry that you didn't see me showing the slides earlier in this section. Okay, so that's how the channel decisions that you make influence the 3 different financial statements for the business. The other decision that you make in the business is this one. The product mix. And this is one, and I'm just using red and white. In Napa, of course, it's Cab versus something like a Sauvignon Blanc or other red blends or different things. But the SKUs, the combination of products that you sell, have a big influence on the different financial statements as well. The red, it depends on, the combination of price and volume is going to influence what you see on the income statement. Reds in our market tend to be much higher margin and much higher price, whereas the whites tend to be lower margin, but higher volume because you get buyers in that you might not get on the higher priced Cabernet. So that's the impact on the income statement. The reds tend to have much higher inventory carrying costs because they tend to sit in cellar for 3 to 5 years. So there's a huge investment on the production side, which drives up the cost. And as accountants, we in fact have to record those costs of being in the production facility year after year, which many people don't realize that it's not just the cost of whatever the farming was for the year of harvest, but you also add production, winemaker time, and all those things for each year that that material is in cellar to the cost of that vintage. White wines tend to come in and go out quickly, so there's less inventory carrying required. It's a benefit for both the cash flow statement and for the balance sheet that you don't have to tie up quite as much inventory for the white wine. So there's higher inventory values typically related to cab, lower inventory values related to the whites. The cash flow, there's a longer gap between the costs that you incur and your ability to recoup those in the form of revenue. And whites tend to have a faster time to market and a faster time to positive cash flow. So if you look at the cost of bottled wine, and this is what we found, and this is, an estimate. These vary from brand to brand, from varietal to varietal, from location to location, but this is what we see here. The Cabernet Sauvignon packaging is about 21% generally, the cellar costs are about 38%, and the grapes are about 41% of the cost that you finally see on that when it goes out the door. Chardonnay, the package is 29% of the cost, cellar 32, and the grapes. And again, this to be all over the map. This just give you some idea of how the prices stack up. And then what's left is the margin after you take that out. There's a whole lot of complexity in inventory costing. Inventory costing is one of the most frightening and least understood aspects of being in the wine industry. Very few people understand what we as accountants do with the cost. But we have to consider the farming cost, the grape purchases and production costs, and then bottling and packaging. And we, in fact, have our clients reflect these costs on the P&L, on the income statement. And then once a month, we have them move them over to inventory, which is where they, in fact, belong, according to what's followed. So farming typically shows up in bulk wine inventory at the end of the financial statement run after we have people correctly account for them. The grape purchases and production go into bulk wine inventory. And then when you move that wine inventory over by bottling it, it moves into the bottled wine inventory and includes the bottling and packaging cost. Tax treatment continues to evolve. In many cases, if you're a small enough business, you can expense the cost of farming directly and not have to keep track of it. They have changed this rule multiple times. You can do it for tax purposes, but it is going to distort the results if you manage your business based on what the tax rules say. And of course, they change every year. Grape purchases and production is going to usually reflect inventory plus a share of other costs, storage costs, and in fact, interest expense for tax basis. It's going to be fully loaded for tax purposes. Again, we have a set of rules that we must apply in order to do the tax accounting for inventory costing. And then all three, both methods will show the bottled wine inventory at whatever cost, even though it may be a different number for both purposes. So when we accountants come in at the end of the year to do the financial statements, we will create multiple sets of costs. We'll do a book costing, and then we'll do a second set to reflect the inventory based on tax basis. And then we will adjust it a third time if we're selecting to use a LIFO inventory method. And LIFO is last in, first out. And that says that you are looking for a tax benefit in the way you choose to cost your wine. And you are assuming that costs increase each year, which means you will get a tax deduction based on the increase in cost of inventory. Most of our clients in Napa Valley are on the LIFO inventory costing method, which just assumes that you are selling the last item that came in first. And that means you are selling the most expensive item before the other items generally. And that is in inflationary times, that is always true. And that generates a tax savings for wineries and others. So I just want to go over the sort of cash timeline again for a second. So you have this in your head, and most of you know this, you're in it and you see it. But year one, we do the farming and the grape purchases, depending on what kind of business we're in. And year two, we might do the packaging. Hopefully we sell something about year 2 or 3. If we're selling cab or red wines, it's not going to happen until year 3, 4, or 5. And so you see, we've got a bunch of costs coming in each year, and the revenues are taking a while. So let's say year 1, I got my farming and grape and production stuff. I spend a lot of money. Year 2, I have some more for that same vintage. And then maybe in year 2, if it's a white, I can sell something. But if it's a red, it's going to be year 3, 4, and 5 for that same 2013 vintage. And that E&P column is eventual net profit. That's what we're looking for at some point down the road. And so then there's your eventual net profit. And then 2014 comes along, we got a whole bunch more costs. And you can see if you look at year 1, there's a bunch of outflow. Year 2, a bunch of outflow, a little bit of inflow. Year 3, maybe we've started to see some positive net cash coming in, and then it takes a while for all of this to line up. So you see how those extensive first year costs are hard for us to recover from. It takes a while for that to get to profitability. So then, there you're out in cash in year 1 and 2. Year 3, you might have a little positive back, and then you start to see a bigger return in the form of cash in about year 4. So this is one of the things, again, that people don't understand, that they wrestle with many times. This relationship between production and sales. And it's a critical relationship for people to understand. If I am selling less than I produce each year, if my graph gets out of control, if the growth in inventory year after year, which you plot, percentage increase in your inventory, is higher than the percentage growth in your sales, you're going to be in a cash flow bind. And this is where people end up going astray. They keep producing more and more and more, and their sales don't increase at the same rate. And anytime that happens, you end up with a cash flow problem. So this graph, production is green, and it's growing at a point faster than what the sales graph is growing. And at that point where I have the purple circle there, that is an indicator of a cash flow problem. So that's something that you have to monitor. Are we investing more in production? And you see people get really excited about adding new SKUs and new varietals and new brands and new labels, and yet they haven't been able to ramp up the sales for those new items. It takes more investment or longer time, and you're going to see a huge drain on the cash flow of that winery. So it's just something to watch out for. So just to give you some sort of a context, and we do benchmarking across our own clients at BDCO. BDCO is Broke Markle Davis and Company, the CPA firm in St. Helena, BDCO CPA. And these are some things we found. The average receivable days, and that is a financial metric. That is not going to your aged receivables and looking at the report. That is taking the sales as a percentage of your accounts receivable and converting it to days. And if that is greater than 45 days, then you are probably doing something wrong. And that is in an industry that is heavily direct to consumer weighted. There are other industries and other locations where there's a lot more wholesale, and that number might be very different. But then we've seen patterns. If you have Chardonnay and it's barrel aged, you might see 27 months of inventory on hand at any point in time. If you have more rosé and other whites, so those are some stats just to give you some sort of perspective. It may not mean anything based on whatever varietals you have or the location where you happen to be having your winery. Income statement, we have very high margins out here, 55 to 60%. Again, primarily small wineries, estate grown wine, which tends to command a higher price, and typically in Napa Valley established brands. Return on sales before interest and taxes might be around there. We do non-financial metrics that we provide, again, across our clients. We do benchmarking across our own client base. We have about 150 clients that are wineries. And so we compare different case size wineries to other ones in a generic way so they can see how they're performing. Because we get questions all the time about, are my farming costs where they need to be? What's everybody else spending on sales and marketing? What are these things? And we try to come up with some way to look at it. Farming used to run around 8,000 an acre. That goes up every year. And this year, who knows, because of COVID and all the other stuff that we had to go through. But those are some normal metrics of what we see around here. And again, may be useful, may not. There are lots of benchmarks that go across the US, and there might be some other stats you can get there, but let me know if you're interested in that. I want to show you now. I'm gonna cool. So now in part 3, we're going to talk about what you can do to change the results. I told you the P&L has to be good. You got to have profit, you got to have cash, you got to have return on equity. And now I'm going to tell you what to do about some of this if you aren't where you want to be. And this is the part that I think is the most important. The first question I'd have for you, if you want to improve your financial outcomes, is what is it you're trying to do? What is your goal? And what we use is a tool called Fathom, which is a dashboard, an online dashboard tool. And it helps us present financial information in a way that hopefully is more meaningful to non-financial people, people who aren't goobery like us. And I'm going to share that screen, and it's Fathom HQ, FATHOMHQ.com. This is a dashboard tool, an online dashboard tool. Whoop, I just sent it to.
So quick question.
Let's see, now I forgot what I was sharing here. Okay, so this is fathomhq.com is the company that creates an online dashboard that attaches to QuickBooks Online and QuickBooks Desktop. Everybody seeing it? Tell me I'm not looking at the video. Holler at me. You're seeing it says KPIs?
Yep, looks good.
Okay. So this brings in financial data from QuickBooks Online and QuickBooks Desktop directly and produces some different analytical views of that underlying data. I can decide if I want to create custom KPIs or key performance metrics. I can do a whole bunch of stuff. But what I want to show you, and this is a tool I recommend if you have QuickBooks Online or Desktop that you consider adding to your apps. And it can import from other systems via an Excel spreadsheet as well. It's a great way to present financial information to non-financial people. So it has one screen in particular that is my favorite. And when I'm talking to teams or owners or anybody who's trying to change a financial outcome, the first question I ask them is, what is your goal? What is your financial goal for the business? And then I can show them, based on their current results, what we need to do to achieve a better result for that particular thing. So from my experience, operating cash flow is generally the biggest problem people are trying to solve. I have a sample winery called Le Coup Rouge Winery that is my case study I use for all training that I do for the CPA firm. And Le Coup Rouge, if you don't speak French, is a redneck in French. So that is my sample winery. And I have some numbers that I set up in QuickBooks Online, and 2018 has the best fake data. So if your goal is operating cash flow, can everybody see this? Okay. It's a little light because they made it pastel, but everybody okay?
Looks good to me.
Screen. Okay. So if I'm looking at an operating cash flow, this tells me I'm currently sitting at negative $650,000 of operating cash flow, which means I'm not generating positive operating cash. I'm a redneck winery, so I don't know what I'm doing. And my goal is to get to positive $120,000 of cash flow. These are the things I have to fix. And these are the only things that are going to influence my ability to generate more cash flow. Price, I can either raise my price, I can sell more units, I can reduce my cost of what I've sold, I can fire people and eliminate or reduce fixed expenses, or I have to improve the balance sheet management of accounts receivable, vendor payables, or inventory days. These are the things that influence my ability to generate operating cash flow in a positive way. That's the first step. That's the first educational step I take with anybody who tells me they want to improve a financial goal. Here's your stuff now. Here's what you have. If you want to fix this thing, these are the things that you have to do. And then we would talk to the group or the owner or whoever it is and say, okay, you need to raise your price. Can you raise your price? And they're going, well, no, we're at the top of the market. Can you effectively raise your price if we look at your channel mix and your product mix? Sell more red and less white. Are there things you could do to effectively increase your average price? Can you create smaller bottles and raise your overall average price? What can you do? And then they go, okay, yeah, we can do a little bit there. So I'm going to increase the price a little bit, and I'm going to show you what it does to your cash flow. This model tells me to sell less. If I want to improve cash flow for this particular model, the way it sits right now, I need to sell fewer units. Does that make sense to anybody? Let me see if I can see your faces. Do you think if I come in as your accountant and tell you to sell less that I'm going to get very far with that conversation? Probably not. Because that's a strange thing for somebody to tell you. Well, what this is telling you is if you don't change what you're doing to collect on the stuff that you sell and how much inventory you're creating, the more units you sell, the worse you're going to be from a cash position. So this is a tool that allows me to have a conversation with somebody to help them think through what they can do to improve the financial outcome of the business. So I'm going to skip the volume on this one. I can't reduce cost of sales because the cost is coming from 3 years ago and I can't fix it today for wine that I'm already selling, but I can reduce it in the future. So we're going to skip that one. Yeah, maybe we can fire a few people. We don't like marketing. We're accountants. So yeah. Okay. So there's some more money coming into the business. And then we can look at our collection experience on accounts receivable. If we want to get more cash, then we got to collect faster than we currently are. And if it tells me I need to actually collect 63 days faster than my current experience, let's talk to the team in the room and say, can you guys do anything that'll make your receivables come in faster? And then they'll go, yeah, we should probably be sending invoices out faster or clearer, or we could do them electronically instead of paper. And that should help our receivables collection experience. And we go, okay, so let's do that. We need to pay the people we owe slower. Everybody except our accountant, y'all. We need to pay them first, and then everybody else we can slow down, and that adds more cash to the bank. And then we need to get rid of a bunch of inventory that we have on hand. If we're able to make these changes to these things, then we can improve cash to almost zero. We're almost at positive. If we can get a little bit more inventory out, collect a little bit more, then we're at 53,000 of positive cash flow. These are the things you must do if you want more money in the bank. If you are a winery with this situation, this is the kind of thing that we need to be aware of. What are the steps we can take? Not just how bad is the damage, but what can we do to improve the outcomes? And this is the kind of stuff that I spend all my time now trying to help people do. Fathom HQ, it's a tool for you. It's a great way to learn how things are connected. It creates, you can create KPIs that you measure and monitor. You can educate your teams using this tool. It's got all kinds of cool stuff. I can look at trends. I can compare it to myself. I can create a target and see if I'm performing above or below that target. It's got lots of insight, but the thing to start with, in my opinion, is that goal seek screen. Determine your goal and then figure out what you have to do to make that happen. Questions or comments? Let me get out of Fathom. I can't find the screen stop thing. There we go. Everybody okay? Okay. All right, thank you. Okay, screen. So here's the shift that we have to make. And this is for accountants and for business people. What we usually think about is revenue minus expenses equal profit. But I want you to think a little bit broader about what's going on in the business. And what really happens in the business is it's inputs. We have things that we input like grapes. We do stuff to those inputs, and then we have outcomes that happen at the other end. Most of the measurements that we have at hand, most of the stuff that we accountants give you are measuring at the end of this process, the outcome side of this. We're figuring out if you did right or not, and we're telling you this is bad, and come back next year and we'll tell you if it's badder or better, right? We're telling you, what have you done? We're not going to tell you what to do in here. We're going to measure this with a P&L or balance sheet or a statement of cash flow. But we don't have a whole lot of stuff typically to help you figure out what to do to make it better before the next time we see you. So what we need to do is to shift the focus from that historical measurement to this. If you want to change the outcomes, we need to think about the people and the processes that are being applied to produce the profit. And if it's not enough profit, that's where we need to look. And we need to find things to measure at that point and not wait until we get to the end when the financial statement doesn't reflect what we want it to reflect. So we want to leverage what we call the profit equation, which is the stuff that we do, the number of customers times the frequency, times the average sale, times the efficiency with which we address that sale, and drive different outcomes. And what we're used to measuring is, again, this stuff when all the damage is happening over here in the activities. So that's where we need to find ways to measure, count, and think about different things versus what we're used to seeing over here. And the scale has been tipped for most of our experience, most of my experience in accounting, to this measure. And there's a lot of stuff we can do over here to fix things. So we get, and this is a classic thing that we have, people that have tasting rooms that are still able to have tasting rooms. The goal is to increase the revenue in the tasting room. And if we ask the client or the team, what it was that we need to do to increase the revenue in the tasting room, we'll get something like sell more, right? And if you ask the sales team, they'll say specifically, we need more visitors in the tasting room. The problem we have is a traffic problem, because they'll point to the person before them. If you're in sales, the person who caused the problem is the person before you, and that's somebody in marketing. So what we want to do is break that revenue down into the components. So what we're saying is we need more people who are buying, and we need them to buy more, right? Spend more money with us when they buy. And so those are the two levers that we need to push to drive that revenue increase. And so we decide what's easier. If I'm presenting to a group of folks who are trying to fix this, I'm going to say, which one is easier to do? Get more people in or get the people that come to buy more? And then we break that down into, okay, what are the things we can do? Get each visitor to buy more. We can train people to sell differently. We can raise our prices. We can have packaged offers. We can do upselling. And you start getting the team, the people who are in front of the sales, to come up with ideas that they want to implement. And this is when you move the needle on any financial measure that you're trying to improve. It's when you get teams engaged in the solution. And I'm going to show you a tool for that. Everybody okay? Any questions? Share yet another screen. I think I need 12 monitors. I thought 2 was too many. Okay, so you should be seeing a nerdy looking spreadsheet. Everybody see that? Okay. So this is what we do, and we do this with teams. So this is, again, my sample winery, Le Coeur Rouge Winery. This is my profit equation planner. This is a tool that we built to show winery staff, the people in the tasting room, what they can do to create more revenues for the business. And so this is a what if model, and I'll send this to you as well after we're finished, where we have volume and we have price. So 2 main drivers of what we're trying to accomplish. I can sell more stuff, or I can do something to influence the price of what I'm selling. And so again, we asked tasting room people what they needed to be able to sell more, and they always said it was a visitor traffic problem. So this model says, okay, here's where we were. We had 260 days open. Remember, we're rednecks. We don't open enough days. And we get 22 visitors in the single wide each day. We have a trailer, and we can only hold 22 people. And of those 22 visitors, only 10 buy each day. And then that's a conversion ratio of 45%. And on average, they buy 0.38 cases, which I think is 4.62 bottles. So this is where we are right now. If I want to drive more revenues, and I'm talking to the tasting room folks, and they tell me that visitors is the biggest problem, I'm going to say, okay, I'm going to add more visitors to your tasting room. I put 5 more people in there, and nothing changed. So this is where I'm going to see the impact of whatever changes I enter down here. I put 5 more people in the tasting room every day. Why doesn't that lead to more sales? Anybody want to chime in and tell me?
You're paying them either hourly or salary?
So do you think, so I have a tasting room, and I'm used to getting 22 people a day in there, and they're buying X amount. If I put 5 more people in there and nothing else changes, they're just 5 more bodies in there. I didn't say they bought anything, right? So I got to get those people to buy. I can't just keep shoving bodies in there, and that's not the core problem. I can shove 10,000 people in there, but none of them buy. I haven't done anything. So that's step 1. I need more people, but what I really need is more people to buy. So people think this is the problem, and it's really this. Of the people who do come, why are only 10 out of 22 buying? Let's get nobody else in there, and let's get 1 more person to buy. Now I'm making a revenue impact. So you see the difference? And when I show that to tasting room folks, okay, yeah, I put 200 people in here if you want. It doesn't do a darn thing to revenue, because you guys got to convert them. And the more people I put in the tasting room, in fact, probably the less I'm going to sell, because it's not going to be a great experience. So this is the kind of model that you use to get the people in the tasting room on board with driving revenues up. And then I say, okay, what else can we do? What if those 10 people, what if we don't get anybody else to buy, but we get the people who did buy to buy more? So instead of an average of 4.62 bottles, let's get them to buy 5 bottles. And now I've got an incremental increase in the cases per customer. And now I'm adding revenue that way. And then we can say, okay, what if we don't change any of this stuff? So we don't mess with volume, but we go down here and look at what we're selling on average. 41% of my sales are Chardonnay, 49% are Cabernet, and 10% are Cab Franc. My pricing data is over here. The Cabernet is $7.20 a case, and the Chardonnay is $2.40. So if I want to drive up revenues, I'm going to sell 5% less to Chardonnay folks and 5% more. And look what happens to revenue now. I didn't sell any more to any more people. I just focused on more Cab and less Chardonnay. Now I have empowered those people. And then I say to the tasting room staff, what can we do to make that happen? And they go, well, I can just bring out the Cab every time and say, you got this Chard, this is a similar level of Cab. Would you like one of these too? And people will buy. I mean, they have a million ideas, but they've never seen it presented this way. So this is how you move the needle on whatever financial goal you're trying to influence, by creating models that let people see what they can change and what they can personally control. If I show this to you today and tomorrow you come in knowing that you need to get one more bottle of Cab to each person who buys than Chardonnay, I have a specific incentive and goal in mind. I can sit at my tasting room and do stuff differently than what I did yesterday. And I can drive revenues up for the organization. So let's say if we could get one more person to buy a day, and we can get them to go to 5 instead of, now I'm looking at some real revenue. Now I'm looking at $125,000 revenue impact for those actions. And now I got people excited and I can say, yeah, and we're going to give you 10% commission of this additional profit you guys generate between today and tomorrow. And let's see if anybody can make stuff happen, and things will start to happen. And then we can look at not doing discounts and all, but this is the kind of model that we need to bring financial information to life and to actually influence the outcomes, not just report on historical bad news. Okay. Got on my high horse there for a minute, y'all. It fires me up. But this spreadsheet is just a stupid spreadsheet I put together. It's called the Profit Equation Planner. It's a Mentor Plus tool that I have had the privilege of being able to use for a lot of time. It's what we use with winery clients. It's how we move the needle on what we're doing. So the message is, financial success is a team sport. Just in time for the Super Bowl. Hopefully you are seeing the football screen with the dogs.
Yes.
Yeah, there has to be a basset hound on at least 3 slides in every deck, or I haven't done my job. I raised basset hounds. They're part of my thing. We had 2 females my whole life. I don't have one now, but so basset hounds always show up in my speaking stuff. Okay, so, but it's a team sport. You can't do it by yourself. If nobody knows what the heck you're talking about, if you're the accountant, it's your job to educate people. If you're in leadership, it's your job to get your teams educated. You need to connect what they do to individual financial goals if you want them to be involved in helping you achieve them. You got to educate the people. You've got to set a clear goal. This is one of the things that just floors me sometimes. People don't know what the financial goal is. We've had clients who tell us that we don't tell people which wine is the most profitable because we don't want them to create bigger discounts. They don't know the margins on each bottle of wine. They don't know all these things, and yet they're supposed to help you drive more profit. So you need to educate them and show them what the goal is so that they can be a player in support of that goal. And then you want to give them things like this that let them see how they can change behaviors to drive different outcomes. And so that's how you do it. So with that, I think I'm a little early, but I don't think anybody would be mad at me if I let you go before the crack of noon. I want you to type in the chat, if you wouldn't mind, what stood out for you. If you have any questions, I'm here to answer them. And we'll get the spreadsheet out to you. Jennifer, I'll send it to you and you can email that out. I won't make people try to slog through the chat loading thing again. Questions come back in from mute or chat or?
Yeah, this is Dan. Thanks a lot, Gene. It was great.
My pleasure.
I have this one question about calculating our wine inventories for our balance sheets.
Yeah.
So in our litany of sort of, figuring out which percentages are going to be FOB, wholesale, direct, we sort of estimate a business model sort of plan, just almost an arbitrary percentage. Is that the sort of summation of all those, compared to the actual inventory, that price that it should be? Is that what would calculate that that inventory value, or these all wholesale, or what do you recommend?
Well, the inventory is valued at cost, which has nothing to do with where you're selling it. Okay, that's the first thing. The inventory is costed. The cost is, so if I have a bottle of wine and I'm selling it to retail, wholesale, or on premise, it's got the same cost. And the cost is all you see on the balance sheet. So it doesn't have anything to do with that. But what it does have to do with is your revenue budget. So you need to take the inventory that you have on hand and decide how much you're going to allocate to which channel so that you know what your potential revenue is going to be for that wine that you're going to sell. Does that help, Dan? The cost is the cost, regardless of which channel you're selling it to. And then the revenue for that wine is going to vary based on who you're selling it to, the margins that are available.
Right. Okay. So it's not the theoretical value of all that wine. It is just what it costs.
The cost. Remember, I told you that was one of the things that people have argued about forever, is that we reflect the balance sheet is always at cost. And that's true for land, that's true for inventory, that's true for everything you see there. It is not the retail value of that stuff. Now, some of us have to report that to the bank because they know that's the potential maximum value you could get for it, but it is never reflected on the financial statement at retail or wholesale or whatever. It's reflected at cost, what it took us to get that wine into that inventory.
Got it. And then the other question was just on that point. I think you used the term fair value. Is there a term for businesses that are sort of undervalued when you look at just a balance sheet and you say, well, this isn't in reality what this is? Is there a term for that?
They're called GAAP compliant. They're filing their financials based on what they're required to do. And what you need is a banker who knows how to read beyond what's presented on that cost basis financial statement. And most bankers in our industry know that there's a cost basis and a much bigger retail value related to that wine, depending on which channels are the primary sales channels. So bankers take that into account in their head if they're smart, if they get what's going on in the industry. And if they just say your value is only what's reflected in the cost, then they're being extremely conservative in how they value that business. If you're doing a business valuation, you would look at the potential sales value of the wine, but that's very different from doing a financial statement, which is cost basis.
Super. Got it. Thank you.
You're welcome. Anybody else?
Yeah, Geni, it's Stan in Virginia.
Stan, go Virginia.
Go. The question, we're in just in year 5 now, and one of the things that we've been really grappling with is, I guess everybody in the industry does at first, is defining what the constituent or the components of cost of goods sold should be. Is there a template or some kind of a model that you've developed, that you've adopted, that you think really most accurately captures cost of goods sold, including, partial allocations of G&A salaries? I mean, this sort of thing. We're really,
it's all the costs incurred up to the point of bottling.
yeah.
So it's production related costs, it's winemaker cost, it's all those costs. It includes no sales and marketing, which people try to throw in there. So it's up to the point of bottling. It's the labeling, it's the bottling, it's all the stuff, all the workers, all the farming, all of that stuff. And then you stop at the point of bottling. That's your cost.
Okay.
And then anything you do after that is G&A.
Okay.
So we pull out winemaker, we allocate the winemaker's cost between what they're doing related to production and what they're doing for sales and marketing, and put that out of inventory because we just want the production related winemaker cost. And then we allocate that, and we have a convoluted accounting-y complicated spreadsheet where we allocate across the gallons by how long they're in the cellar and spread those costs, including depreciation on the facilities and all that stuff. So that's the cleanest way to think about it. Anything it takes to get that stuff into bottle is what you consider, and you stop at that point.
Good. Thank you. Also, just FYI, the slide that you had on, I think you called it key financial data, just giving sort of some seat of the pants or experiential averages or rules of thumb.
Yeah.
Really helpful, particularly for me being half a continent away here, or a continent away, to see what I assume are largely California values, but really helpful to benchmark. So thanks.
You're welcome. Yeah, it is California. No, our costs are way out of whack out here. I still can't believe what it costs to buy a house. I moved here from Atlanta, and I'm still trying to figure out, people are crazy. My outhouse is very expensive out here, y'all. So yeah, do take that into account. And it's hard. People always want to know the number, and there's not one. And there's so much variety in what you're doing and how and your costs, so. But there are most local areas. There's so many wineries now across all, states in the U.S. Most industry associations have some sort of benchmarking available. Our Napa Valley Vintners have some. And there's also a company called Community Benchmark that benchmarks some of the California communities. They gather data from them and then share it with folks. So talk to your industry association about that. They probably can give you better local statistics.
Thank you.
You're welcome. What'd you do to your arm, your hand? We got to know.
Well, I had the thumb joint replaced yesterday. So lifting a lot of cases of wine when you get really old will do that to you.
Oh, that sounds horrible. I'm glad you're on the mend. Hope you have good drugs.
I have a question that's related to cost of goods as well. My business model is a little different than the typical one. So I'm a grower. I don't
Yep.
produce the wine, but I have a tasting room.
Tell me who's talking. Who's my here?
Oh, my name's Chantal.
Hi, Chantal.
Hi.
Okay, so you're a grower.
Grower. I don't do the
Yeah.
production,
Yeah.
and then I have a tasting room. So that middle piece for me is missing. But my question is related to pricing fruit. So
Yes.
because I grow my own fruit, I don't have a contract with myself per se. But we do have huge variability. I'm in Michigan, but everywhere we grow, we have huge variability in yields from year to year. And obviously our farm operating costs or our costs on the grapes are super variable. So if we have a year where we lose 90% of our crop, are our cost of goods still just what we would charge for? I mean, is it just limited
Your
to?
cost of goods sold are your farming costs
Yeah.
that year. That's your cost, no matter how many units you produce. So if I have a bad year and I spend, like us, let's say we spend 100,000 for farming,
Mhm.
that's our cost, regardless of how many tons we're able to yield from the harvest, right? So in a year where you lose the crop, you're going to have a hell of an expensive crop for whatever you end up being able to sell, because those
Right.
farming costs all get spread to that little bit of fruit.
Mhm.
But that's different from, so if you're selling to yourself, then you just take all the farming costs and that's your cost of goods sold for that vintage.
Right.
But if you're selling to somebody else, then you allocate the units from that total farming cost, and that's your cost of goods. Now that doesn't have anything to do with price. What we price is what we can get in the market. That's what we do in Napa.
Mhm.
We don't take cost times X%, but you could do that if that's, I don't know what your market is like, but you got to look at what everybody else is getting in that market and price accordingly. But your cost is what you spent on farming for that year. That's your vintage cost. And that's what's so bad about that. If I have a small vintage, my costs skyrocket and I can't raise the price. So
Well,
I have a low margin year when I have a low yield year.
I know some businesses that, they have contracts with growers and they guaranteed to pay them a certain price every year, no matter what the crop is.
Right. That's
So
right.
they have like a steady cost of goods every year.
No, because their per unit cost still varies. If they're paying 100,000 every year and the vintage and the yield is smaller, their cost per unit is varying based on what they produce.
Yeah.
So they have the same challenge. The profit per unit is going to be influenced by the units you're able to pull off that vintage.
Okay.
Make
Thank
sense?
you. Yep. Thank you.
Okay. And you can email me if you want to talk further, or call me or whatever. I'm going to put I think my email is on the next slide that I'm not currently sharing. Are you seeing that slide?
Yes.
Okay. Yeah, let me know. I'm happy to talk about that in more detail if you need more specifics. Anybody else? Question or comment? So if you wouldn't mind, while we're waiting for questions that come in the chat, if you just type in for me what stood out for you about what you learned, I would greatly appreciate it.
Genie,
Yes.
Marion had a question about the winery software, which I suggested that she email you about that. She was asking the same question I was earlier about the best accounting software. So, but I didn't know if you just wanted to say anything or just wait until she have her email you.
So Napa Valley, there are 500 wineries in our little 30-mile strip here. And most of the wineries that are here are small ones. So most of them are on QuickBooks, either desktop or QuickBooks Online. Most of them moving to QuickBooks Online. There's another tier of bigger wineries that Jennifer knows. That's how Jennifer and I know each other. They're on an older piece of software that Jennifer used to work with called AMS, comprehensive but old. Jennifer would not argue with that. There's more higher end software products, basically from a company called Navision, which is where I used to be. I used to be a software executive there at Navision Software in Atlanta, which sold to Microsoft, and it's now called Microsoft Dynamics Nav. And they have taken it to the cloud in a product called Business Central. There are 4 or 5 implementers of that solution specifically customized for wineries. And they are very knowledgeable folks. We work with a reseller named Ozterra, which I'll type in here, that does both the traditional desktop version of Nav and Business Central. Winery software. And the Business Central option has allowed the pricing to go down. Nav used to be a relatively big investment, And now that they have a Business Central option, it is more approachable for smaller wineries, but it is still a big leap from a QuickBooks to any of those tools, AMS or NAV or Business Central. It's a much more comprehensive investment. And then there are lots of tools people are using for all the other stuff, the point of sale, there's Wine Direct, there's Commerce 7, there's Figure, there's a ton of those. There's a ton of Harvest Tool. I mean, I know I do a lot of stuff with tech. That's one of the things I speak about technology too. I speak to accountants in tech, and I'm always looking for new tech to solve winery problems. So if you've got something like that, reach out to me. I'd be happy to talk with you about whatever you're trying to find. So there's my email. Not getting anything that stood out.